Hello again, everyone. This is Ken Weber, president of Weber Asset Management. Today is Tuesday, October 18th, 2022. As usual, I'm here in New York, and on the other side of the country in Lake Tahoe is Jack Bowers, our chief investment strategist. We have a lot to cover today, so we're just going to get right to it. Jack, I think the first thing we want to start with is fears of inflation. That's on everybody's mind. Everybody has an opinion. But I trust your opinion. Tell us what you're thinking.
Well, inflation has definitely turned out to be a much bigger problem than most anticipated. And we've certainly seen the hit on the bond side. I think we're at least getting to a more stable point where inflation is high, but not necessarily increasing at this point. And we're actually seeing some signs of declines in the manufacturing sector. So we might
Which is what the Fed, that's what the Fed is looking for.
Yes, exactly. Yeah. So I think we're starting to see used car prices come down. We're seeing new car prices stabilizing. It's obviously more expensive to purchase a house because of higher interest rates, but building costs are not going up the way they were before. Right. So I think, maybe it's going to be tougher to get inflation down to this 2% goal that the Fed has than it looked at the beginning of the year. But I don't think we've encountered a situation where it's going to be going up any further than it is right now.
Right. And we do want to point out it's a global problem. And you were telling me before we started here that the U.S. seems to be now, and in the near term at least, better poised in terms of inflation and economic progress.
Yes,
poised than most of the rest of the developed world.
Yes, I think our consumer spending is stronger here, partially because of the tight employment situation, and while the economic slowdown here is likely to pinch consumers, as are the high energy prices. I don't think it's going to be as much of an unemployment problem as it usually is in recessions. Right.
So if there's a recession, an official recession, I think what I'm hearing from you is it'll be mild.
Yes, I think last I read, based on the indicators, it's somewhere around a 63% chance that we'll see a recession.
63%. Okay.
I don't really know if it's going to be a mild recession or if we'll narrowly skirt a recession by staying positive with our GDP numbers, but you can definitely say there will be a pronounced slowdown, and because we already know, of course, consumers are being pinched by higher prices, especially when it comes to energy.
And again, to reiterate, the Federal Reserve actually wants the slowdown.
Yes.
It's counterintuitive to many of us, but they need that to get inflation under control.
Correct.
So we all have to accept that, bite the bullet. It's not pleasant, but that is what this government and all governments going back for decades, what the Federal Reserve tries to do.
Yes, and I don't think the medicine here is going to be so stiff as it is in Europe, where the energy inflation and the energy shortage is a much bigger problem. And as a result, those central banks have to potentially push interest rates up at a much more rapid clip than we have here.
All the hurt is magnified over in Europe, especially Central Europe. But France, Germany, England, they're all going to feel the pain of the Russia problem. With energy that they can't get from Russia that they had been getting. So, as much as we might hate the pain that we feel here, it's really much worse for much of the developed world.
Right. And, it's not just Russia. There's other factors that are causing this energy crunch in Europe. There's an issue with corrosion in nuclear reactors in France, which has effectively taken a big chunk of the nuclear electricity production offline.
You said corrosion?
Yes.
Okay.
And then there's a problem with low water levels, which is not only reducing the amount of hydroelectricity available, but it's also in some cases complicating moving freight around.
When you say low water levels, you mean actually in the rivers?
Yes.
Yeah. Right.
And that's, in some cases, that impacts what you can do with electricity production because you don't have a cooling water supply. That has impacts in the nuclear sector. It sometimes has impacts in the coal sector. So it's kind of just a worst case scenario when it comes to electricity for Europe and natural gas. I think those governments knew it was coming, and they put a lot of natural gas in storage at very high prices, and they are now pricing consumer energy at a very high level to encourage conservation. So I think I'm optimistic that Europe will get through the winter without any downright shortages or outages, but it is going to be a very expensive proposition for the consumers who are going to have to really open their wallets this winter. So it isn't pleasant, and it's going to take away from the amount of money that they have available for other consumer purchases.
We're going to get to talk about stocks and bonds. I know you have a lot you want to say today. I just want to talk about the OPEC Plus action, where a lot of people felt they stabbed America in the back, and there's give and take about whether it was a terrible thing or not so terrible thing. What are your thoughts on how OPEC?
Well, I think the Saudis
first defined what they did. You know, just,
I think the Saudis are kind of allied with the Russians by necessity, and they've got to consider their interests, even if they don't really want to. And a complicating factor, of course, is the Saudis see the oil business as something that's only going to be generating meaningful revenue for them for maybe another 10 or 15 years. And so, you know, when they're presented with a situation where they maybe charge more than they should, and maybe even enter some demand destruction, a lot of that is just kind of driven by the Saudis' desire to maximize revenue for the amount of oil they have left. Because
and just to be clear, the OPEC Plus has decided to cut back like 1 million barrels a day. I forget the exact amount. 2
million, yeah.
Yeah, and so that's going to hurt America and especially Europe.
Yes, OPEC Plus refers to an alliance of both OPEC members and the Russians.
Correct. Right. So it's on a lot of people's minds right now as a bad thing, and it is a bad thing, I think, short term. But you're saying long term. You were telling me earlier about the shale production issues and things happening. Just touch on that for a moment, please.
Yeah, so U.S. and Canada are both major shale producers, and of course Australia is a big natural gas producer as well. And I think anyone who has the ability to boost production is working on that right now. It's a little more expensive on the capital side because interest rates are going up, but it is still happening. And I think you know, when OPEC Plus cuts production, it's eventually going to be made up by all the areas that are not part of those energy alliances. And we're also getting some relief on the electric transportation revolution, which, you know, is small now, but will probably be big later. Because especially in Europe and in China, battery electric vehicles are now accounting for more than 20% of total vehicle sales, much higher than they are here in the US. So, you know, it takes a while to build the base, but that eventually is going to cut the demand for oil as well. Natural gas is a little tougher because it's used in industry, it's used for heating, but it's more of a distribution challenge right now. There's a decent amount of natural gas to go around. It's just getting it to the right places. And I think Europe will have more receiving ports for liquefied natural gas, so they can, you know, use what the Australians and the US and Canada produces. Right now, they simply can't because they're locked into all those pipelines that they depended on. So I think just in a year, we'll see a significant easing in the European energy crunch.
Right. Now, I want to get to the stock and bond markets. And I mentioned earlier that coming across my computer this morning was a headline: U.S. stocks poised for 16% bump in the short term. That's from a Morgan Stanley strategist. And I only bring that up not because we necessarily agree or disagree. Just how, to me, it's funny how they come up with a number like 16% from yesterday, from today. It's impossible to know what we'll do by market close today, let alone have a target of 16%. And I bring it up because a lot of people saying, Ken, shouldn't we pull out and wait till things calm down? You can't do it because there are some very bright people who think the market is poised for a bounce up, at least in the short term. They may be right, as always. They may be wrong, as always. But I just want you to know there's some very bright people who are very optimistic, think this is a buying opportunity. With that said, Jack, I'd just like to hear your thoughts on the stock and bond markets.
Yes, we've seen this before around the bottom of a bear market where you have these wild guesses with high precision accuracy. And I think to some degree, you can, for every optimist, you can find a pessimist. Jamie Dimon's
Absolutely.
come out, on the other side of
Yep.
the coin with his predictions. But I think, we're kind of doing what we've always done at this stage in the market cycle, looking for the best opportunities. And on the stock side right now, the mid caps and the small caps have lower valuations than the S&P 500, and they are more insulated from the global economy. A case in point, the S&P 500 or S&P 600, which is a mid cap, small cap index of sorts, compared with the S&P 500, it only has about 20% of its revenue coming from foreign sources, whereas the S&P 500 is more like 40%. And then you look at the forward PE ratios, the S&P 600 is around 11 for the next 12 months earnings, whereas the S&P 500 is 15, 16. So it's a situation where you're getting a substantial discount on smaller stocks and possibly faster earnings growth. So we're in the process of getting more invested in that S&P 600 universe. And I think that's really going to be the key going forward.
Great. And it's interesting to me because the S&P 500, which is what the headline numbers tend to be, has really run away from the rest of the market over the last couple of years.
Mm-hmm.
It's sort of held up better on the downside, and previous years it did better to the upside. And you're saying you foresee a shift away from those massive mega stocks, which is what the S&P 500, even though it's 500 stocks, it's really only 50 that drive all the action. So you're saying you're seeing leadership change in the next couple of years.
Possibly, yeah. It's not uncommon for smaller stocks to lead when you get a market recovery. And I think that's definitely a possibility this time around. It's not, of course, guaranteed. We're coming off a 10-year period where the S&P 500 has outperformed the S&P 600, a very pessimistic scenario for the smaller stocks. And you definitely see that when you look at the performance over the last decade. But I think going forward, there's enough of a valuation discount now on smaller stocks that there's a high chance they will outperform going forward. And we're not, of course, putting all of our eggs in that basket, except perhaps in our more aggressive portfolios. But we're definitely trying to take on a more substantial weighting in that sector.
I'm optimistic over the next 6 months. I don't know what the next 6 months will bring, next 3 months, but I'm quite optimistic that most of the scared money has already exited the market.
Yes, we've had several chances to exhaust the sellers, and then, of course, new bad things like the British pensions being forced into selling U.S. stocks, come along, and then we have another down leg. But I think we are kind of getting to that point where anyone who is inclined to sell has mostly done so. There's always a risk that we'll have more bad news on inflation, more bad news on energy. But I think we're entering a period where there's a chance for some positive surprises as well.
Well, this Morgan Stanley strategist might be right, or he might not be, or she, I don't know.
Fingers crossed, yeah.
For a 16% drop, not 17%, 16%.
Mm-hmm.
And we have 2 minutes left. Tell us about the bond market, short-term, long-term. What do you think?
I think that's the kind of the tough situation this year. We've seen bonds take a much bigger hit than they normally do in a situation like this. And I think as a result, it's going to take bonds a lot longer to recover than stocks going forward. Our view is, we've had a situation where it was not a good place to be in bonds. You can look backward and say, we should have been in cash, and you would be right. But I still think going forward over the next 3 years, there's a chance to do substantially better than a cash investment in bonds. As far as where the opportunities are, the high yield sector, the upper tiers are looking relatively attractive right now, and we're probably going to be boosting our exposure there. You can get, yields in the 6-7% range now with bonds that only have 2 or 3 year maturities. And there's a reasonable argument that high yield companies are in better shape than they normally would be in this point in the economic cycle, simply because there were ample fundraising opportunities when capital was cheap during the pandemic, and most of them, got where they wanted to get, and now they're just kind of opportunistically doing new issues at higher yields when it's justified. So I think the defaults in the high yield sector are going to remain much lower than they normally are in a recession, and for that reason, with yield premiums now being where they are, you're reasonably assured of having a premium yield and a premium performance in that sector. And we're looking to take more advantage of that going forward.
I basically agree with you, except I think the bond market will recover a little bit faster than you think. Time will tell.
Yes, yeah, we definitely, just from reinvested income alone, it's probably a 3-year cycle. If in fact we get a little relief on the interest rate front along the way, then it could be faster.
Right. All right. Well, we've reached the time that we set for ourselves, and thank you, Jack, and
Thank you.
everybody else. Good seeing you. We'll see you next time. Thank you.
Alrighty, bye-bye.
Stop recording.